Can be heard, yeah? Hi everybody. The excitement's not going to wane at all. You're getting to speak to an economist now, so that's going to be very exciting, I assure you. But the thing, I guess, about me and what I talk about is it's the one issue you have no control over, and that's the housing market. So I guess it's positive to look at where we've been and where we're going in terms of housing market dynamics. So hopefully I can give you some positives today in terms of where the market is, its journey, and where it's going to pan out over the next 12 months particularly. I'll just move to the side to see we're all working here. So today we're going to look at the current state and future prospects of the Australian housing market. We'll focus on Melbourne and just see how Melbourne has been comparing to other markets. It's important to understand that housing markets do act in cycles, and it's almost a predictability in terms of the cyclical outcomes in the housing market. And this has been none more evident than over the last 4 years, particularly since the GFC, or predating that even to the previous mining boom. So at the moment, I guess our theme in terms of where the housing market is that we're moving from recovery to consolidation. Okay, and that's a key understanding. It's a key point because it does reflect that phase. We need to think of phases of the housing market, and we are definitively in a recovery now. And it's just a question of moving into the consolidation period. Just a quick ad, I'm a senior economist for Australian Property Monitors. We're leading data providers. If I can just cut to the chase, we're direct competitors to RP Data, so we provide the same sort of service. However, we're connected with Fairfax and Domain, who are our parent company, so we have the advantages of that relationship. Oh, there, excellent. All right, so let's do a little bit of a history lesson to start with. So the current state of the housing market, as I mentioned, we're moving from a correction to a recovery phase. 2011, I don't have to emphasise to you, that was a downturn in the Australian housing market generally, a correction phase. We saw house prices falling as affordability collapsed. And that followed steep price rises through 2009 and 2010. Melbourne's median house price rose by 30% from the beginning of 2009 to the middle of 2010. Clearly an unsustainable outcome. Record levels of price growth through that period. Sydney up 20%, Brisbane up 11%. So that was part of that factor that crushed affordability through that period, and we saw the market correction. Of course, we also had 7 interest rate rises through that period. So all these things coalesced to push affordability down, and of course we had the corresponding correction in 2011. And other factors that influenced that correction was we had a faltering economy through 2011, we had unemployment rising, confidence generally was down, we had issues with the mining tax, the carbon tax, and we had some catastrophic weather events. Not just the Brisbane floods, not just the floods in central Queensland, but also the tsunami in Japan, which took 1% of Australia's GDP through that period. So it never rains, it pours. Our affordability had declined because of those issues in the previous boom period, and then we had a faltering economy. So last year, 2012, the light started to shine through, and as is typical with Australian housing markets, we started to gradually enter a recovery phase. Now, it may be interesting to know that the bottom of the housing market, the Australian housing market, and we'll talk about relationships later in terms of state-based markets, happened in the December quarter 2011. So the housing markets have actually been growing since the December quarter 2011. A year ago when I was doing presentations, my biggest problem was the talk of the housing bubble, that we were going to be presented with 10, 20, 15 or 10, 15, 20% falls in median house prices in the future, that Australian house prices were heavily oversold, that affordability in terms of incomes versus prices couldn't be sustained. Now, the good thing that's come out 12 months later is that it's proven to be nonsense, right? Nonsense. The Australian housing market has again proved its resilience and its robust nature, and is back up and running, and certainly well into a recovery phase from that. And we've gone through all the process of comparing it with the US and the UK, and of course, as I say, we might as well be comparing the Australian housing market with Jupiter, because the similarities are the same. Okay? So emerging recovery last year, we've had an improvement in affordability, interest rates and house prices were down, incomes and rents were up, improving affordability. We saw first home buyers, investors and change-up buyers reactivated last year. First home buyers were reactivated, particularly given some changes to state government incentive schemes that brought forward a lot of demand, particularly in Sydney and Brisbane, and also Victoria to a certain degree, Melbourne to a certain degree. Investors started to look at the more of the longer-term prospects of Australian housing markets. You don't need much to get bricks and mortar investment up and running in Australia. It's part of our DNA for a number of reasons. And we also saw change-up buyers starting to be reactivated, and a lot of that was based on the perception that the market had been oversold. And people perceiving that, my God, look at this. I mean, these prices are 10% below, 15% below where they were 2 or 3 years ago. So that sort of momentum started to build as well, the value momentum, and particularly in the prestige market in Melbourne. And it's the prestige market in Melbourne that started to lift last year and was the key driver of that revival in the Melbourne market. And it was a fact that people perceived that higher priced properties, inner suburban properties in Melbourne, were at a level which was almost irresistible in terms of value. So that's where we saw the market lift in Melbourne last year. And forward indicators such as home loans, clearance rates and median house prices all rose last year. That gave us the sense of not only the market had bottomed out, but it was back on the way up again. So this year, we're starting to see that recovery consolidate this year. Okay? The Sydney market has definitively recovered. Right? It's no longer, is it recovering? Are we in a recovery phase in the Sydney housing market? The last two quarterly median house prices in Sydney have been at record levels. So Sydney's moved from a record median house price in December to a record median house price in the March quarter. So that means that market is now expanding. So it's moved from the recovery phase into the expansion phase, and it's an imminent outcome in Perth. We'll look at the figures in a minute, the exact figures, but it's an imminent outcome that Perth will start moving into that recovery phase. Now, we've seen consistent price rises in Melbourne and Brisbane over the last 2 quarters. Melbourne's recorded consistent quarters of median house price growth, which is the first time since 2010, the beginning of 2010. The median quarterly price rise in Melbourne over March was 3.6%, highest rise since June 2010 during that very strong trading period. Don't want to call it a boom, but it was very strong there. And a leading indicator of this, of course, is the auction clearance rates. Have risen steadily for the last since the beginning of 2012. And I've got a graphic there that illustrates that later on. We'll have a look at. We've seen investors and change-up buyers continuing to be activated. Some markets, investors are more active than others, and we'll have a look at that also shortly. But general buyer activity is also emerging. One of the factors in a recovery is it's patchy. Parts of the market recover at different phases according to the nature of the drivers of those market segments. So you always get this patchiness, not just between capital city markets, but also between sub-markets. Okay, so they operate at different levels according to those drivers in that emerging recovery phase. And of course, we've got record low interest rates. A big surprise. 5% mortgage rates, and people want to buy houses again. Hello? It's ever been the same and will ever be thus, that when we get to that low interest rate point, it activates the housing market. And that's what it's designed to do. It's designed to generate that underlying demand in housing, that latent demand in housing that Australians have, and then move into construction, move into investment. The problem we're having now is it's not moving into construction, but that's another story. Okay, record low interest rates, confidence is rising. We're not sitting here as we were a year ago saying Australian house prices are going to fall by 10 or 15%. Ask Steve Keen, he knows. This is Armageddon for the Australian housing market. Just look what happened in America. It's going to happen. Well, we don't hear that sort of stuff anymore, do we? And that's good, because in the real estate industry, they are negatives that have long-term effects on the viability of this industry, right? And because the headline that always grabs you is house prices falling. Oh, I've got to read about that. House prices rising. Yeah, well, what else? Of course. They always rise, don't they? And of course, we've gone through that low confidence period at the beginning of last year. because of those types of headlines that we had to deal with, but we don't deal with them now. And economic optimism is better. We're certainly looking a lot more positive about the economic outlook in Australia, following the economic outlook internationally for where our housing markets are travelling, in terms of more confidence about spending, job security and income rises. And of course, as usual, the economy is the key to a sustained recovery. And we are in still a bit of a twilight zone as far as the economy is concerned. 1 week good news, next week bad news. We had some bad news last week, $12 billion budget deficit outlook. That's going to mean more fiscal consolidation through the feds, and that'll work its way through to the state government. That's not a good thing for economic growth. However, the stock market, it's back up again. And that is good news for certain sectors of the market. So the jury's still out on the solid longer-term direction of the Australian economy at the moment. But we still have low and stable unemployment rates and rising wages. Our interest rates are steady, and steady interest rates are just as good as falling interest rates or rising interest rates, because it provides certainty to the marketplace. Okay? I'll talk about interest rates later quickly. Confidence has improved. Retail sales are up. People are starting to spend a little bit more. Australians have moved from spenders to savers over the last 10 years. More conservative attitude, paying down the mortgage, paying down the credit card. That's now starting to shift a little bit more of those, a bit more confidence and a bit more speculation and a bit more activity from buyers. So we're seeing that confidence improve. Stock market approval, critical part of the housing market equation, is where the stock market goes. I will show you a graphic later that illustrates that clearly. All right? But also, we still have these mixed speed economies. South Australia and Tasmania are performing poorly. Brisbane has had issues in terms of a lot of job cutting there, which impacted that economy. Perth is the strongest economy in the world. You know, and that's why everybody's moving to Perth at the moment. Darwin's still very strong. The New South Wales economy is actually performing quite strongly. There is a mixed outlook for the Victorian economy. Okay? There's a lot of efforts by the local government here to stimulate the economy, particularly through construction, particularly through high-rise construction in the inner city. Okay? Victoria relies a lot on the construction industry for its economic growth. So the jury's still a little bit out on what's happening in the Melbourne economy. So just quickly, this is the house price cycle over the last 7 years. A couple of things there. The green line is Melbourne, but we can just see the impact of various factors on the movement in the house price cycle. We had the resources boom 03-07, we had price rises then. We had rates rising, if you remember, the Howard government. Back then we had those rates rise because inflation was out of control. Employers were going to their bosses every week saying, hey look, I just got this great job offer, he's offered me an extra 10 grand. All right, I'll give you 15. And that started to happen. Of course, the Reserve Banks had to move in there because that had the risk of creating a wages price spiral. All right, so we had a lot of interest rate rises through 06-07. That took the top off the market. But the get out of jail card for the Reserve Bank was, because asset prices were already falling, was the GFC. So that came along and we could blame the GFC for all the bad stuff. Okay, so, and of course, house prices fell through that period. The federal government moved in, first home owners grant boost, okay, gave every first home buyer virtually a house. Here's your house, it's for free, go off, enjoy, all right, as well as all those bonuses and fiscal stimulations that happened. And we saw prices rising through that period. Again, as we said originally, an unsustainable prices growth through that period. The genie was out of the bottle. 30% in Melbourne, 20% in Sydney, right? You don't have to do much to get Australians to buy houses, okay, especially when you give them $20,000 deposit just up front like that. And that's what happened. So, in the natural process, the Reserve Bank said, oh my God, this has gone too far, let's put up rates. They put up rates 7 times through that period, took the top off the market, and of course, we're now seeing the other end of that with rates starting to fall again at the end of 2011. Okay? And guess what? We're seeing the housing market pick up again. 3% historically low interest rates that we have at the moment. Okay? 5% mortgage rates for all your buyers. Fantastic stuff. And of course that's going to activate buyers, and we're seeing now clearly this growth, this upturn in the housing market cycle. It's definitively starting to grow. Okay? And we'll see why just one growth from one cycle affects all the others from one particular capital city. But you can see here how Melbourne is starting to strengthen, right? Its price growth over the last 2 quarters. All right, let's just see some numbers, some quick numbers. 2011 correction, Melbourne was the outlier, right? House prices fell by 5.1% in 2011. But let's remember, they were up by 30% the year before. Okay, you do the math. All right, Sydney as usual, very stable through that period. Sydney has a very robust, resilient housing market for reasons we won't go into. All right, last year the recovery commences. Sydney up 4.5%, Perth up 5.5%, Melbourne just flatlining. Good result considering where it had come from previously. But last year in Melbourne, a lot of the activity was from the prestige market. What happened in the block last year? Remember the block, Channel 9? People say, oh yeah, geez, it's all, marketing. It doesn't represent what's happening in the market. But it did. It was the beginning of the signs that the inner suburban markets, particularly in Melbourne, were generating more activity, more confidence in those buyers, say above $1 million buyers. Right? And that was the start of that activity. And that's what kept the market active last year. So our latest price figures have Melbourne up 3.6% over the quarter. Now they're very strong figures. And they're the strongest figures since the boom of 2010 for a quarter. Now, if we look more closely at the figures, it's been driven by the upper part of the market. Prices in the prestige market over the March quarter rose 11%. Okay? Now we're talking inner Bayside, inner suburban, inner east markets, right? Rose 11%. Now that sounds fantastic, but we'll look at some figures that put that a little bit more into perspective. And this is it. Now this is where each capital city market is in terms of its previous price peak. Okay? So we can see, as I said, that Sydney is now at record levels. It's expanding as a market. It's 1.6% above its previous price peak, which was last quarter. So it's moving from record to record. Now, the Melbourne market's still 4.1% below where it's been. Okay? It's catching up. It's catching up. It's certainly now starting to outperform Brisbane and Adelaide, who are still well behind where they were previously. Now, that shows the capacity of the market to expand to its previous level. And when it does get to that point, and it maintains that point, that's a recovery. Okay? That's a market that's recovered. So certainly Melbourne is now starting to move forward. I've got some other stats which will look at that a bit more clearly. So let's see from the GFC through to now how markets have performed. And Melbourne house prices have grown by nearly 20%, including what happened in the GFC. 20%. And that's the best performance of any of the capital cities since the GFC. Now, we can take a longer snapshot and go back, and these things change. But the GFC was a line in the sand. I've got 10 minutes. Now, let's just look quickly at some market segments, because I'm here to show you what drives some of those market segments. So we've had the history level. We've basically got 3 markets, okay? We've got the budget market. The budget market is driven by first home buyers, investments and investors, and a key underlying factor in that is rents. All right, the rental market. Middle market, upgrade buyers, they're driven by job security. All right. Then we've got the prestige market. And the prestige market is activated, I call that, by high prosperity buyers. So they don't have the same sort of organic drivers that other parts of the market. And a key indicator of where the prosperity market goes, or the prestige market goes, is the stock market. I'll just leave that one. We can see the difference here between, in terms of investors and first home buyers, why first home buyers are active in Melbourne consistently and why investors aren't. And that is because Melbourne rents are significantly below every other mainland capital. Okay? There is no growth in Melbourne rents at the moment, hasn't been for 2 years. It has the highest vacancy rate of all the capitals, right? And it has the lowest yield. So it's not exactly investors' paradise, okay? But it's really good for first home buyers in the sense that they can park themselves in the Melbourne market paying notionally a lower rent relative to other capital cities. So it's that very accessible Melbourne rental market is part of the driver. Now, at the moment, we're seeing huge activity in Perth and Sydney in investors. Sydney now has around about 50% of the Sydney market is being driven by investors. at the moment, which is a record level. Investor activity in Sydney has increased by 27% this year compared to the same period last year. Okay? So investors are driving that Sydney market at the moment. In Melbourne, it's situation normal. It's about where it has been. So investors haven't declined, but they're still active, but at the levels they're always active at. Okay? Because there's always property investment for other reasons other than, gross returns and the prospect of capital gains. Now, another key driver for upgraders is the unemployment rate. Now, we look at the average unemployment rate here, and we'll compare it to the average prices growth last year. And you can see cause and effect there. We can see that the highest or the lowest unemployment rate per capital city has the highest house price growth. Now, the one exception there in this beautiful model, we can see Melbourne's right in the middle, but you can see how this is declining or rising as that rises, that grows. You see the relationship. The only exception there to that beautiful little piece of modelling, thank you, is the Canberra market. But the Canberra market at 4.1% unemployment is actually coming from 2% unemployment. So it's actually going downhill fast. And this has a lot to do with the federal election. It's got a lot to do with the budget outcomes at the moment. There's a lot of job shedding happening in Canberra, and this has put that market on stall. So let's look at the prestige market now. And this is a great graphic because this shows you the correlation between Australia's prestige property markets and the all ordinaries. Okay? The green line there is Melbourne. The dark blue line, okay, is the all ords. You can see almost the identical pattern of activity from that. And the other thing you can see is that prestige markets in all the major capitals that have prestige markets move the same way over time. This is the top 10 percentile of all suburbs, okay, by median house price. So you can see that the stock market is a key leading indicator of what happens in prestige market, okay? And look, we've got Melbourne rising here strongly, the prestige market, as I mentioned, up 11% over the quarter, and we also have the all ords up strongly over that period. It's not an exact cause and effect, but what drives the stock market drives what people want to do in terms of prestige property buying. So let's just have a look at how each market is at the moment in terms of status. Melbourne's budget market, okay, is 1.8% below its previous peak. So it's starting to get close to its previous peak. The middle market is 4.5% below its previous peak. But the prestige market is still 12% below its previous peak. So even that's the market that's growing. Of course it's going to grow because it's got so far to get back to where it was before. Okay? So let's just have a look at where the economy is going now, because the economy is that underlying, the underlying key to what happens in our housing market. So we still have a positive international outlook. The US economy, look, forget the up and down China stories. It's up, it's down, inflation, spending's down. China remains a very strong prospect for Australia and will remain that going forward. I mean, it's sad to see they're only growing at about 7.7% per annum at the moment. It's just a tragedy. We're at 3%. The US economy is the big story. It is now recovering. It still remains the world's largest economy in the consumer market. The Eurozone issues, we don't hear about the pigs anymore, do we? We're not hearing about pigs every day, the Portugal, Italy, Greece, Spain issues and how that's going to destroy our financial markets. It's gone. All right, forget it. Now, commodity prices will rise and the dollar will fall, which is very important at the moment, gradually as the US GDP and interest rate rise medium term. The US is still printing money. Its interest rates are at 0 and will be at 0 for the next 2 years. The Fed has said that. It is still printing money. That keeps our dollar up. No matter what happens to us, our dollar will be up because the US dollar is down to stimulate its economy. And that's what's happening. Of course, we forget other markets such as India, Brazil and Indonesia that are emerging markets for us anyway as a resource exporter. Now, Australia, we were ranked last year number 3 in the OECD for economic performance. Our growth last year was the best in 5 years. The resource boom is still a factor. We still have a good jobs market. these mixed-speed economies are adjusting. Have you been to Perth lately? Have you got onto a plane and it's full of guys going to work in the mines? Sydney, Melbourne, Brisbane, they get on the plane in the morning and they're all off to work. Okay? And that's the process of adjustment that we see when underperforming economies drag labour from, overperforming economies, that is, economies which have labour shortages, they drag labour from, that's why we're a federation, you know, drag labour from underperforming economies. We still have, sadly, this week's announcement means there will be more cost cutting, tax rises, fee increases in the federal government, which is going to put a dampener on economic activity, and that may mean lower interest rates sooner rather than later. Okay? Not sure that'll happen, but I'm not sure that's a good idea, believe it or not, even though lower interest rates are always good news for mortgage holders and home buyers. But it's the big picture we're looking at. So interest rates to remain low, and of course jobs and house prices are the key. Unemployment rate starts to rise again, interest rates will go down, but they will watch very carefully what's happening with assets. Now there's the mining boom. It's all over, Red Rover. We can see where the mining boom peaked, all right? And this is mining construction work yet to be done, ABC data. Now this is a good reflection of what's happening in the mining boom. And we can see that the mining boom has come off its peaks, all right, and coming down. Clearly, this is Queensland and Western Australia mining construction work to be done. But let's look at it in perspective. This is the equivalent job creation that work yet to be done in the pipeline will create in terms of a 1-year full-time equivalent job. And that's not just on site, that's downstream. So Western Australia still has the capacity to generate 220,000 jobs. That's why everybody's going over there, right? Because that's where the work is. Similar for Queensland. All right, so let's have a look at some forecasts for this year. All right, we'll just concentrate on Melbourne. I believe that the budget market in Melbourne, which is up to $500,000, will rise by between 0 and 3%. Okay? Particularly given a change to the first home owners grant that was announced this week by the Victorian government will now be solidly just for new home construction. Okay, that'll affect the established property market to a slight degree and that budget market. Middle market, similarly 0 to 3%. The good thing about Melbourne is there's a top-down thing happening in Melbourne. That higher market that we've discussed led the charge last year is now dragging up middle ring, middle price range suburbs. There's more activity there, there's more confidence there. We're starting to see higher clearance rates and prices growth there. So 0 to 3. The prestige market will continue to run, okay, 3 to 5%, I believe, and that's properties over 3.5 million. So that's a 3 to 5%. I was going to go a little higher, 5 to 7%, but I still think there are question marks over the Victorian economy that may take the top off the market over the remainder of the year. So I think that we're looking at a 3 to 5% growth. But we went back by 0.5% last year. So we can't expect, you know, this is a gradual, controlled and expected recovery in house prices. So for the year so far we're 3.6%, but we've got winter coming up where we will see lower prices growth, perhaps. And also some particularly grey clouds on the Australian economy. So those interest rate leading indicators show clearly where the markets come from. Keep looking at your auction clearance rates. They have signalled the revival of the housing market over the last year. Late spring 2011, auction clearance rate 50%. Now that's climbed 50%, 55, 60, 69. Is there any coincidence that prices have risen accordingly? Once you start getting an auction clearance rate in Melbourne over 60%, you start to generate prices growth. I just want to finish off by saying that the thing that we need to know is that the Australian housing market has proven itself to be the most robust and resilient housing market on the planet, okay, given that we are an open, market-driven economy. You just ask the investors from China who are flowing in here by the hundreds of thousands to buy Australian property. Hundreds of thousands. I do an event a week to Chinese investors. Okay, and some of the reasons is we have chronic undersupply, a tight rental market, and we have immigration because we always are low for labour, so we're always looking for extra workers from overseas. That drives house prices. We have a high ownership aspiration for financial reasons, for cultural reasons, and for reasons of prestige. Okay, we have this high aspiration from home ownership. And it's also an investor magnet, bricks and mortar security. And of course, because of all this, investors, occupiers and investors have preferential tax treatment. No capital gains on the family home, and we can negatively gear investment properties, and we can also write off through depreciation schedule. And we have that great thing from the banks, who have that wonderful LVR, consistently 80% of the loan. When the market's down, you're going to have to really prove that that value is what it is, okay? They are one of the keys to the stability of our housing market. We don't have market forces generating mortgages as they did in the United States, where their LVRs started to go like to 120%. You want a home loan? Well, how much is it? Okay, well, there's the money for the home loan. Would you like another 50 grand? Come on, 50. We'll make it 70 grand. And is there any wonder the place, had some very serious problems in that scenario? And the other thing we're starting to see is the emergence of self-managed super funds. Self-managed super funds are another pool, other than from the banks, that are now moving into the housing market. And they are the next big story for investors. Now, I'm going to finish off saying this with a concept, all right? And that is, history tells us that Australia's housing markets are trend-linked. So what happens over time in Hobart will happen over time in Perth and in Brisbane. It is because of those natural macroeconomic stabilisers that keeps markets in sync. All right? And we can see that there, that long-term housing cycle, except for that little Perth bubble, and they're paying for that. It's not a bubble because it didn't burst, it flatlined. But all those markets, the trends are always the same. No capital city markets miss out. Some start off a little slower, some are a little bit ahead of the pack. But over time, there is an underlying noise of house price in all capital cities and all submarkets. All right, so I always say that a rising tide lifts all boats. A rising tide lifts all boats. I'm sure you've heard it. Everybody copies me. But the thing is eventually, all right? So eventually over time that rising tide lifts all boats. And this is Australia specific. Economies, employment, incomes, population growth, prosperity, confidence, and in the end house prices. The rising tide lifts all boats. We need to continue to have confidence in our housing market and reject the nonsense from the doomsayers. Okay? The one positive thing this year and last year is that it has been proven to be nonsense. And yes, the next time we have a downturn because of the business cycle, it'll all be, oh, here we go, folks. Here we go. 20% down. We're all going to be living in caves soon. You know it. I know it. Just get ready. And of course, they will make zillions from their websites and their reports and all this sort of stuff. Whereas the industry has to keep on keeping on with the confidence to know that this Australian housing market, proven again to be the most resilient, the most robust and the most accessible, and that's a whole other story, of any comparable market in the world. And that's my lot. Thank you very much for your attention.
Thank you.